Hello everyone, welcome to today's US Open live webinar. It is Tuesday, November 28th, 10 minutes before Wall Street opens. As always, I am your host, Nikos Tsapouras, Senior Financial Editorial Writer at FXCM. Inflation remains in the spotlight. We had the Japanese figures last week, which showed persistence, and this week we expect updates from Eurozone and the US, critical data given where monetary policy is. And there are more key events coming up, which include the postponed OPEC meeting, the policy decision by the Reserve Bank of New Zealand, and more. These are some of the themes we will be discussing about in today's session, but as always, please read carefully through the risk warnings and the disclaimers before we begin. Okay, let's get the ball rolling. We have quite some ground to cover. We're going to start with Euro USD, as always, which catches a bit over the last couple of hours. Then we're going to talk about USD versus Japanese yen, which remains under pressure after persistent Japanese inflation. Then we will move into the Nasdaq, which made a cautious return from the holiday shortened week. We're going to talk about oil prices and the expected OPEC meeting. Postponed, was supposed to take place over the weekend, but was postponed for Thursday. And we're going to round things off with key releases ahead, highlighted by Eurozone and US inflation. Now, Euro USD is tentative at familiar levels, awaiting the inflation updates from Eurozone and the US, for which, as I said, we're going to talk about later on. The pair is trying for its best month of the year, as the greenback is weighed by market optimism around the Fed. The advance brings the 1.1096 resistance in the spotlight, but fresh impetus will be needed for tackling it, and we remain cautious around the ascending prospects of the pair. But again, the next leg of the move will likely be determined by the data we talked about. The move looks stretched at the 61.8% Fibonacci troubles the common currency again, although we now see an effort to leave it behind. As long as this doesn't happen, there is scope for a slide back to the 200-period DMA at around 1.076, although further losses have a high degree of difficulty. And there is also the daily Ichimoku cloud to support any further loss. Inflation is still far from the 2% target in the US, and the Fed may still need to do more. But the ECB, meanwhile, paused last month, and inflation has decelerated significantly while the economy is weak. So there is room for staying in the sidelines from European policy makers, and that could, of course, contain the advance of the common currency. But as we said, at this stage, it finds renewed vigor and tries to leave this 61.8% Fibonacci region below it. Now let's move to the US dollar versus the Japanese yen. Japanese inflation remains elevated according to Friday's data. CPI ex-fresh food ticked up to 3.9% year over year, staying above the central bank's 2% target for the 19th straight month, while policymakers had recently upgraded their forecast for this fiscal year and the next. This keeps pressure on the BOJ for policy normalization, and it has been making steps in that direction, losing its grip on the yield curve. At the same time, markets believe that the Fed is done tightening, and this keeps the pair under pressure this month, and it is in risk of lower lows, but the next lower lows were just over the 1.47 handle, but the next support at around 1.4443 looks distant still. On the other hand, the Fed has kept more tightening in play, and the BOJ has not shown any imminent desire to change tack. The daily Ichimoku cloud has supported the pair before and can do so again, and give the greenback the opportunity to push for a return above the 200-period EMA. You can see here at around 149.50, although that won't be an easy task, and a rapid rise does not look particularly easy. Now let's move on to the NASDAQ 100. Wall Street made a cautious return from the Thanksgiving holidays, and NASDAQ 100 continues its consolidation around the 16K handle. But of course, these week's releases have the ability to jolt it out of that region. The November resurgence has brought the all-time highs in the spotlight, the familiar 16,770 level, but these may prove elusive in the near term. The recent indecision we see creates risk of a slight back towards the 200-period EMA at around 15,400, but sustained weakness looks hard under current conditions. Not much to add for the tech-heavy index. Not much has changed since our previous session. It is on an obvious upward trajectory, but shows some exhaustion, and will need the next catalyst to determine the next leg of the move. And now on to US oil. The commodity heads towards its second losing month, and it is definitely in risk of lower lows, although sustained weakness here again does not look particularly easy given supply cuts, massive supply cuts. It finds support today, and we can see an effort to reclaim the 200-period EMA at the 80 handle, but as you can see, the upside contains multiple hurdles, and it does not look friendly. But there is a key event coming up, so let's move to what we expect over the course of the next couple of days. The OPEC Plus meeting is first. It was scheduled for over the weekend, but was postponed for Thursday, and that in itself had pressured oil prices because it is a sign of disagreement amongst members. The group has a plan of production cuts to the tune of 2 million barrels per day, which are scheduled until the end of 2024. But Saudi Arabia and Russia have been implementing extra supply curbs on top of that 2 million barrels program, but there has been dissatisfaction around the rising output levels of some members, and Saudi Arabia seems to favor more cuts because of this slump in prices that we have seen over the last couple of months. So the outcome of that meeting will be critical for oil prices. There is some drama. There are reports that it may be delayed again, and as always, such OPEC meetings have many do have some drama around them, with many leaks and many comments and counter comments. So definitely some caution needed there. Now, the main event, of course, is US and Eurozone inflation on Thursday. From the US side, it's the PCE report. The last figures had shown some persistence, but the most recent CPI report revealed substantial deceleration. However, inflation is still far from the 2% target, and although the Fed may have already done enough, more tightening remains on the table. The ECB has made substantial progress on inflation recently, since CPI fell below 3% in October, and now we wait for the preliminary November figures to see if the momentum will continue. If it does, it will make the life of European policymakers easier and allow them to stay in the sidelines after having paused their tightening cycle last month after 10 consecutive hikes. We also expect the US Q3 GDP figures on Wednesday. It's the second reading. The first reading was a significant growth of 4.9% annualized from 2.4% final Q2, and the highest in almost a year. The US economy has been very strong, but there are some signs of cooling recently. We also expect China's manufacturing PMI on Thursday. Factory activity has been in contraction territory since April, with the exception of just 1 month, which highlights the frail nature of China's recovery. And before all of that, we expect the Reserve Bank of New Zealand tomorrow. The RBNZ is a front runner in monetary policy, in monetary tightening, having started in October 2021. However, it paused over the summer and stood pat for second straight meeting last month at 5.5%. The labor market is cooling. Inflation has been coming down, and policymakers did not hint to more moves, and baseline expectations are for another hold on Wednesday. However, employment is still above its maximum sustainable level according to the central bank. Inflation has shown some stickiness on a sequential basis, and the economy posted a surprise rebound in Q2, while the central bank's recent forecasts project a terminal rate of 5.6%, leaving room for more tightening. So that's pretty much it for today's session. As I said, lots of events coming up. So that's it from me. We will talk again with the outcome of some of those events on Thursday at our usual time, 10 minutes before Wall Street.